Hi, this is Kurt Kringelis, Senior Credit Strategist with ING Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. The fixed income markets delivered weak excess return performance in November. Excess return performance was the weakest since May as concerns surrounding the fiscal cliff weighed on the markets. Heavy supply was also a contributing factor to the weakness in the higher quality sectors. Risk was not completely out of favor, though, as the higher risk segments of the market still managed to deliver positive excess returns. Within the investment-grade corporate market, there was no consistent economic theme to the performance pattern. The financial industry performed very well during the sell-off. Uncertainty surrounding the fiscal cliff weighed on the market generally, and heavy new issuance volume added additional pressure to particular industries. November was the heaviest new issue month of the year, with volumes for the month being about twice as high as in recent years. The financial industry performed very well during the sell-off, aided by relatively light new issuance volume. The solid relative performance of the basic industries may be an indication that investors have not necessarily soured on the economic outlook, assuming a constructive resolution of the fiscal cliff. On a year-to-date basis, the financial industry is now back to being the only outperforming industry. The strong showing of the communications industry in recent months had allowed the industry to move into an outperforming position. The energy industry also had been gaining ground on the market, but both of these industries performed poorly during the month. It now looks increasingly likely that the financial industry and perhaps the communications industry will close the year as the only outperforming industries. The communications industry only lags the market by about 30 basis points, but the energy industry now lags by about 200 basis points. The corporate market showed weakness in November as concerns about the fiscal cliff and heavy new issuance volume weighed on the market. We believe that the weakness in the corporate market will be temporary, assuming that a constructive resolution to the fiscal cliff will be achieved. Recent economic data has been respectable, and investors continue to show an appetite for risk, as evidenced by the positive excess returns for the month in the high yield and emerging markets. Historically, the market has performed well heading into the new year, but the fiscal cliff negotiations could alter the timing of this pattern. We are likely to maintain a risk-on bias unless our confidence gets shaken regarding the prospect for a constructive resolution of the fiscal cliff.